probably about an hour, including Q&A. If we kind of go over, then we kind of go over. You're very welcome, One Moon. I'm just gonna do it on the Discord stream subject. All right, I'll be right back.
In the meantime, community, feel free to check out our free resources. Look at all our signal channels. Look at our trading channels. Look at our analysis and market updates. All these resources are free to the community, and we look forward to providing these avenues of education for the public. And then please check out some of our discount links. We're partnered up with a lot of good companies. We only support products that we use. Please check them out. If you're interested, please support the community. Thank you guys for showing up for the meeting. Umada will be back to kickstart this very, very soon. He's just drinking a little bit of water, and he will be back to start and spearhead this meeting. It's going to last approximately 1 hour, including Q&A, for those interested. Yes, and then just to specify, we do live trading every single day here in the server, market open at New York Sesh, as well as after hours. We have traders from all over the world, really good traders on future side, option side, share side, and we look forward. We look forward for this community showcase. Please have your hardest questions for Umada. You know, you should never have to hold back, right? With a presenter of this level and this type of pedigree. So please give us your hardest questions. Umada will be more than happy to answer them. And without further ado, I'm going to go into the comments as well, chat. And I will be looking forward to this meeting together with you guys. I will be playing support as well in the comments. Please let us know if you guys need anything.
I just got back. Hello. So, we do have some more people kind of joining in right now. Just kind of wait and see if they are fully here. Misha, is everything good with recording? Gotcha. Appreciate that, IBM. It's weird. Hundreds of people know my personal schedule. So, we're about, let me see. Okay, about 8 minutes past. So, let's go ahead and start the presentation. So, first of all, thank you guys all for coming. This is my first workshop here in public on OA, and I know that you guys have been asking for a lot of like learning resources. Sometimes it can feel like, okay, man, you know, it's always behind like a mentorship, but this is actually going to be pulled straight from the mentorship. So this is a section, right? Mentorship has 5 days of lectures. This is the day 4 lecture where we spend all of the day talking about risk and what goes into risk. Here's a subsection of the lecture called position sizing. So inside of the risk category, we would have previously talked about, what is risk, how do you manage risk, and then we get into position sizing as well as other things. So all of those factors. I hope you guys enjoy it. This was made with basically custom 3D blended content. So everything that you're about to see here, from the logos to everything, is all really nicely done by our team here. And we do have like a world-class designer. He's actually designed Assassin's Creed. So very, very, very talented. And yeah, that's basically our graphics artist. So without further ado, just get set up, double check everything on my end here. Yeah, this here is the excerpt from the mentorship. So module 4, risk. And before I kind of continue, can everyone hear me okay? Yes? Perfect. Okay, let's go. So we like to start off every single module in mentorship with a quote. It kind of helps frame everything. And so this is the funny quote that we've picked for position sizing. It's called Size Matters. Okay? And it's going to be by every woman. We like to start off sort of every single kind of module or every single kind of lessons with a particular quote that will kind of help frame things in the right way for you. So today, size matters. And what does that mean when we talk about size matters in trading? So position sizing has 4 considerations. You have your initial sizing. We'll go over kind of what each of these mean. You're going to have your initial sizing. Then next is we're going to talk about ratios. And I've actually drafted up a ratio table. So no one actually really talks about ratio tables. Then we're going to talk about drawdown, what that means in the context of position sizing, beyond just, how much are you red. Very, like, can your account basically take the drawdown? And then stop orders. So what do you do when position sizing just, doesn't work? So first of all, let's kind of talk about what this entire module is about. The number one thing is most traders that are coming into kind of trading for the first time, is it easy for us to talk about, buy here and sell there? Yes, it is. When we talk about, people who are kind of looking for signal discords or signal services, it's, okay, tell me how much to buy, when to buy, what price to buy, and then tell me when to exit. That's it, right? And that's pretty much their extent of trading. It's sort of one entry, one exit, more or less. It's an okay way of trading. It's very basic. It's it's obviously very cut and dry, very, very simple. It's not really too much you can do with that. And we'll go over some examples of kind of when that fails, right? So beginning with the initial sizing, some people, particularly when we start trading futures or you're starting to trade options or sell side or equities, your initial sizing is going to be very, very crucial. So that initial amount, whether it's 1 contract, 2 contracts, 3 contracts, or 4, right? Or, if you're going to YOLO, say 5, 10, or 15 contracts right off the bat. Actually, 5 is not really YOLO, but, so let's say if you're going to YOLO 10 or 15 contracts right off the bat, what does that initial sizing do to hinder your position sizing, right? So let's take into the considerations for where our initial first step can be, right? Whether that's good or bad. So let's go into initial sizing first. Let's take a look at what that is. I'm going to use an example actually just from a few days ago. This is kind of when we were challenging 6,000. I know we've just hit almost, actually, did we hit all-time highs today? Chat, did we hit all-time highs today? We didn't. We got close, didn't we? I didn't check near the end. 2 points-ish? Okay, gotcha. Okay, so let's look at this initial sizing, right? So here's a bounce off of various levels. Now you don't have to understand what any of these lines mean at the moment for how we derive these levels, for what they mean and what the color codes mean, right? That's something that we kind of go in depth in the mentorship, but for our intents and purposes here, you just have to understand that these are just levels. So let's assume you're a trader, right? So let's go through a hypothetical situation from about 3 days ago, I believe this was. You're a trader who's looking at us testing 5960 on the SPX. So, you know, anything that you guys understand about OA, you understand that we're basically looking at the general market and how that informs every other moving piece in the market. So whether you want to invest in tech or trade trade a particular ticker or anything like that, it's always in reference to the S&P 500 itself, right? So what's the overall market trying to do? What's your individual ticker or vehicle or instrument of your choice trying to do? So in this particular case, S&P 500, we're hitting 5960. You look at this as a trader and you're like, okay, well, here, there's a little 20-point gap. You can see that once we kind of break this, there's some consolidation, there's some chop. Certainly around the 5960 level, there's a lot of chop, right? Market finally decides it kind of wants to move up, gets ultimately stopped at 5974, rejects back down, and then we finally say, all right, we want to go up. When we start launching, right, there's about 20 points up here. Just no resistance, no levels, no gaps or anything. So we've been looking at the market these days with a lot of, let's say, thin air up here at the summit, right? We're at the top of Everest right now. Really haven't been here for too long. And so there haven't been a lot of institutional orders up here. So what we've been kind of observing over the last few days is, big 10, 20, 30 point runs, and it seems like you just kind of buy in and hold, right? The reason for that, because there's all of these gap levels in the market. So this is one of the things that was happening today as well. When we started to break, I believe, 6128, right? You guys kind of just saw that the market more or less just kind of moved up, just drifts up. There's really no kind of resistance. The resistance that does happen is more or less just from either stop loss raids or traders getting jittery. Excuse me, I'm going to take a sip of coffee. So let's say you're this trader, right? You've been kind of patiently waiting all day. You think, listen, I don't really know about all of this stuff down here, but I'm very bullish on the markets. I want to kind of get myself into a long position. I missed this initial one, right? Just wasn't really kind of seeing it. I didn't really know where the important levels were, but I know 6,000 is an important level. So I'm going to wait for the market to kind of react there. So as this trader, you kind of miss out on this entire move. That's a very common experience, right? So let's walk through this example. You're a trader that misses on this move, but you know that 6,000 is an important number. You're kind of a little bit more seasoned as a trader, so you know that, hey, this initial candle that is kind of breaking above 6,000 here, I'm going to wait, right? This is usually where I get, taken advantage of by the market, where I look at a candle break, it looks like a confirmation, or at least it's holding price above 6,000. So I'm going to go long here, but you've been hurt too many times by the market. So you're going to wait for that little pullback first. So this happens, good, you avoided that. Then the market starts to re-challenge 6,000 for the second time, and you get this big candle up. Boom, okay. You're like, aha, missed the first little fake out here, first little stop loss raid, and or psych out. And I'm getting it on the second entry here. So we get this big candle break. You get in one con, right? Because you're reasonable. You're not a crazy kind of throw everything in there. So 6,004. Let's say you top wick the candle. So that's kind of our starting base for where we are. We missed the initial drawdown on 6,000. We kind of pat ourselves on the back for being that kind of trader. We get the second candle big up. And then we get in with one contract for the initial sizing. Let's see what happens after. So, what happens next? Fuckery. You get in on this candle right up here, goes up a little bit, and then what happens is it proceeds to tank about 18 points against you. So, you have your thesis, you have your idea for how to size. Thank goodness in this example, your initial sizing is not that bad. But this has happened to every single trader. Right? So when we play with probabilities, we play with statistics. At the end of the day, you don't really know exactly. So here's something about probabilities and statistics, right? Because obviously we are in this profession. We talk numbers, we talk stats every single day. You can figure out the probability of something. So take a heads or tails, right? Kind of example. Your simple 50-50 odds. And let's say, I'm going to flip heads or tails on a coin for 100 instances. It should, on average, land roughly around 50 heads and 50 tails. That's the probability, right? But in some extreme cases, it can land up to 67 heads and 23 tails. No, 33 tails. Or it can land 33 heads and 67 tails, right? So that's the upper limit of what is in a random thing, is almost up to one deviation, but not quite. Now, we can know the probability of this event, right? So that's to take these levels here, but we don't know the sequence of the events. And here's what I mean by that. We can know the probability or confidence intervals of certain levels, right? So very easy to say there's more money on this level, this is a much more important level, something rudimentary like that. But when you kind of get into how do the candles play out, how does the actual heads and tails kind of land, we don't actually know. That's still completely random. So we know heads or tails can land 50-50, but the sequence of how which is is it going to be 3 heads and then 1 tail, then 2 tails and then 1 head, or is it going to be 1 head and one tail? And we don't know how the sequence of events plays out. So when we are trading, you will have high conviction trades. So what does this mean in practice? It means that when we're trading, you're going to have high conviction trades where you're going to want to initially position into something, and you're going to position hopefully lightly that you can maneuver and manipulate your entry average. But sometimes it just doesn't work out. There's going to be fuckery in the market because we don't actually know the statistics of the candles. Every single one of these candles, treat them as like a heads or tails. This still comes out randomly, even if we have a sense of where the direction the market wants to go, whether that's up to a particular level, whether that's directionally up or down. The candles themselves are like the heads and tails being landed on a 50-50 probability, or whatever your probability is. It doesn't have to be 50%, but that sequence is still completely random. We still don't know that. So as traders, you need to understand, right, that you can have whatever system that you're using, whatever strategy that you decide to use, but the candles are still ultimately random. And so what you need to do is you need to understand position sizing, because you need to be able to manage fuckery in the market, right? So what happens when you do everything that you told yourself that you would do in your strategy, but the sequence of the candles don't work out in your favor, right? And in this particular example, it actually falls 18 points. So what do we do here? How do we manipulate? How do we damage control? So let's talk about ratios. So our initial con sizing is 1, but let's talk about ratios and what ratio tables are. But before I get into the next section, any questions? Hopefully you guys can still hear me. No? Be crazy if you guys heard none of that. We can hear you, no questions. Do you guys understand? Oh wait, get out of here. Humble feet, get out of here. This is being recorded, yes. So does initial sizing make sense to you for kind of like the pretext that we're setting up and why we need to understand positioning and manipulation? Because we're going to get into some math. Math is spooky, but we're going to make it easy for you guys. Okay, so yeah, right. So let's get into the probability of things and also the randomness of sequences, right? So you can still have 50-50 odds and still be a completely random event because you never really kind of know if it's going to be heads or tails on the next one. You never really know if the candle's going to be green or red. So ratios, what do we mean by ratios? This is something that no one actually really talks about in trading. So you don't need to trade futures, right? You understand, are you guys familiar with my previous outline of the 4 different strategies that you can use in the market? No? Okay, so broadly speaking, let's kind of back up here. There's four strategies that you can employ in the market. There's really only 4. Now you can trade equities, right? So you can be an equities trader. This is where you trade individual tickers. This is your choice, right? The whole whatever has a ticker, you can trade it. That's essentially equities. You're buying shares. The second thing that you can trade in the market is options, right? So options on those tickers, you can do that. The third thing that you can do is you can trade futures contracts. Give me 1 second. Hang on a second. I think my neighbors are going crazy. Yeah, all right. So the third thing that you can trade is you can trade futures. So futures, this is where like we get into like you can trade S&P, you can trade gold, you can trade whatever you want on the futures market. Commodities, you can trade hogs if you want to. You can trade coffee beans. And then the fourth one is you could get onto sell side. That's where you start underwriting the contracts. Right? That's when you start writing some sort of options, covered calls. Those are the 4 main things. Equities, options, futures, sell side. What people don't talk about when they talk about strategies, though, is they don't talk about ratio figures. That is what happens when you buy 1 share and then, this gets, I think, probably more commonly brought up with the equity traders because they talk about something known as DCA or dollar cost averaging. Mostly this is done in investing, right? People talk about DCAing in terms of you bought $10,000 worth of NVIDIA, it goes up or down, you go ahead and you want a dollar cost average in another $10,000, right? So that would be at like a 1-to-1 position sizing. You go from 10,000, you buy another 10,000, you're at 20,000, you take 50% of the average price for where the first entry and the second entry was. Does that make sense? Are we following? Okay. The second thing is you can do like a 1-to-2 sizing, 1-to-3, 1-to-4, 1-to-5. Okay. So let's say your initial con sizing here is like 1, then you want to buy 2 more. So let's say your first purchase is at $10, and then it comes down to like say, $4. So it's done a $6 drop, and then you want to buy 2 more contracts to get to 3 total. So how much does that change your average entry by? You go from $10, and then there's a 6-point difference. You're going to take 66% of that 6-point difference. And so you're going to average yourself down from 10 down to $6. And then it's currently at 4 in the market. Does everyone follow that math? Give me a thumbs up in the chat if you guys are following that math. Okay, sounds good. So let's get into something a little bit more complicated. Am I going to show the actual calculation? Yeah, we're going to show the actual calculation. We're gonna hold your hand through this, Coyote. So 1-to-4, 1-to-5. Here's the manipulations. 1-to-1, I think, is the easiest for you guys to understand, right? 50%. That's how much you can move. You're essentially buying the difference by 50%. So if something falls 10 points on you and you go 1-to-1, then instead of falling 10 points, you average down by about 5 points. Right? If you're going to go 1-to-2, the 10 points you can average down by 6.6 points. If you go 1-to-3, you can average down a 10-point drop against you. You can actually move your entry price down by 7.5 points, so on and so forth. This one by 8 points, this one by like 8.3. So let's look at this first entry long. What's the initial entry price? How much did we manipulate it by? And what's the new entry price? So these are 3 questions. Initial entry price is going to be 6,004. How is this different from doubling down? Yeah, so it is, you can call it doubling down, you can kind of call it dollar cost averaging. I like to just call it ratios because we're talking about fractions, right? So you can double down, right? Doubling down is just sort of 1-to-1. So you can say, I have, 10,000, I'm going to double down by another 10,000. You just get 50% manipulation. But when we want to get more creative, it's going to be like, say, what happens when we have one contract sizing, we want to quadruple down? What if we want to quintuple down? How much can we manipulate our average besides just the simple, easy 1-to-1 50% average, right? So you can double down on a lot of things. You can go from one contract to two contracts to four. Or you can go from one contract and immediately jump to, say, 5. Get yourself to a 6 contract position, manipulate by 83%. So this ratio table helps you kind of visualize the impact of going for higher ratio sizings. Does that make sense? Does that kind of explain the difference between just doubling down? Okay. Yeah. So we can obviously just always do the simple double down. I think everyone understands 1-to-1. But let's say we want to get, aggressive, right? You got a 10-point drop against you. How do we eliminate nearly 83% of that drop? By increasing sizing. When we go 1-to-5, so on and so forth. So second entry, let's say this particular position falls from 6,004, and you kind of hold on for 6,000. It kind of jumps, bounces, rejects, right? You think it's going to come back and retest it, so you're kind of just holding, right? This is more or less within a tolerance of about 4 points here on a major level, and then it rejects down. So you think, okay, shit, this candle's really big. Really kind of takes us down to 59.93, which is another, level that we have here. And you think, okay, well, this has fallen by nearly 10 points here. I kind of want to go for, a 1-to-3 average. So what does that do? I want to manipulate my entry price by about 75% here. So this has obviously come down 10 points against me. That's a lot. I've now mispositioned myself for one reason or another. Woke up on the bad, wrong side of the bed, whatever it was, you're distracted. This is more or less like, okay, we're in damage control. You're in a situation where you have to damage control. So we go for the 1-to-3. We say, instead of a 10-point drop, let's make it like a 2.5-point drop. So let's look at what that looks like. So initial entry price, 6,004. Second entry price at 59.9335. Point difference is 10.65. And we want to do a 1-to-3. We're going to manipulate this entry average by 75%. So 10.65 times 75% equals 8 points we can manipulate our entry by. So we go 6,004 minus 8, you get to 596.1. So here's the first entry. Because we bought 3 down here, our average price goes from here all the way down to this blue line. So you can see the range from the green line to the green line and how much we actually pull down that entry price. So keep your questions until after the ratios thing so that I don't miss your question or kind of get stuck on a question too long. But yeah, so we visually move this down. So when you guys hear me on stream or hear other people on stream and we say, okay, I've got 1 contract, I'm averaging down 2 here, I'm going to buy 3 here, I'm moving myself up to 6 contracts or something. And it can sound like, oh my God, this guy is degenning. He's just going to YOLO this contract. Well, you guys might not understand, especially for all in a trade, if we're looking at the candles, is you might not understand that the con sizings are actually being manipulated. Our average price is being manipulated quite a bit. These are some of the things that we absolutely are doing on mainstream, but you might not fully understand that, right? So this is a visualization where we're not trading at the moment. So now we can kind of talk about this. I remember there was a one day in particular. Reza, do you mind me kind of sharing the example that we had gone through? Sure. Yeah. So this was about, I think, 2.5 months ago, something like that. So Reza was much less experienced than he is now. He's got 2.5 less months of experience back then, and we were running through some trades on the mainstream. I had changed my contract sizing by 6 points that it moved down, and then it ended up coming back in my favor. But in that particular case, Reza had actually taken quite a substantial loss because he had averaged up to 10 contracts, trying to follow along, right, but not really understanding ratio tables. Had an idea of it, but really didn't never really been sat down to kind of go like, this is exactly what you're trying to do here. So he leverages up to 10 contracts, and he says, wow, the account basically implodes. What happened? I was in the same trade with you. I was also increasing my sizing. How come you made it out alive in the green? How come I'm sitting here now with, a lost account? When we finally go through the order book there, we're actually tallying up each order one by one. He had gone from one con sizing, so initial sizing is fine. It's nothing aggressive, very manipulatable, right? Because we can do a bunch of ratios. It's not like he just went 10 contracts and then all of a sudden we can only average down with 5. Right, so that would be like a 2-to-1. So he's getting like almost nothing. He's getting like 33% of the candle. So if this thing wants to tank another 10 points, all he can manipulate by this. He didn't do that. It's not like that. But his average entry actually only moves by 0.1 because he had kept buying around a specific level, and so he went from 1 contract to 10, and he kept getting the mid price between. So he ends up averaging somewhere around like half a point. And so he's really not averaged down at all. And then all he's done is basically increase his con sizing so that when the market finally does kind of dip and then come back up, by the time it comes back up, his position can't handle the drawdown. So this is important to understand. Yeah. So questions. I believe Dr. Betts had a question. How do you mitigate the risk of increased leverage as you average down? Do you tighten your stop loss? Do you enter your position with a smaller size so you have room to increase it afterwards? That's a very interesting question, Dr. Betts. So Dr. Betts is asking, right, this is all fine. We can look at ratio tables here, right? But what happens when we go 1 to 5 con sizing is very aggressive because we're, yes, manipulating by 83%, but now we're holding 6 contracts. So instead of moving at $50 a point, we're now moving at $300 a point on the SPX, or at least on the ES, the future side of SPX. Yeah, so that's a really good question. So there's a couple of things that we can do, Dr. Betts. One, we can talk about drawdown. So can your account sustain the kind of leverage that we're trying to do to save it? And then what happens when we don't? So that's going to be the stop orders. Yeah. So perfect. It's this presentation's set up to answer your exact question. How is that better than cutting and re-entering? That's a really good question, Coyote. So why bother with the ratio tables? Why even do something like this, right? There's a couple of reasons why you might want to do this. So outside of the, why not just, sell at 6,000 and then just buy down here instead of averaging down? We can actually manipulate our average even further without increasing leverage. That's a really good point. So this would be in those situations, Coyote, where yes, you can do that absolutely, and every trader should just, get comfortable with cutting and re-entering. That's fine, whether that's long or short. But for the examples where you get caught out for one reason or another, you have to understand how to position. So you need to know how to play a good defense. So that's basically one of the reasons. If we had just cut up here and then bought back down here, you would have ruined my lesson, Coyote. But this is for those moments where you get caught out. The second reason why you might want to average in or use specific ratios for considering your initial sizing on a level is because, let's say it's 6,000, or let's say actually it's 6,100, right? You know that this is going to be an important level. but you might be, say afraid of a stop loss rate on this particular level. So we have all seen like around these big kind of round, even psychological numbers, you see big gap ups. Why? Because here's a 4-point candle, case in point, it goes up to 606 in short fashion. So 6-point candle. Sometimes these are very aggressive. They can go up to 10 points or more, right? On big levels. Doesn't have to be just psychological. They can be very, very big exposure levels. What you might want to do, right, instead of just buying, say, 8 contracts right here and, kind of playing for the short idea that you want, maybe you're the trader who didn't want to go long. Maybe you wanted to short it at 6,000, but you feel like, hey, it's a big number. We're probably going to punch above. I'm going to need to initially size lower here so that maybe I can average in at a higher price here. So it works in reverse as well. Everything that we're talking about now in terms of damage control can also be used on the offensive as well. So instead of sizing, 4 cons off the bat here, and then absolutely getting pummeled when this moves up, what we can do is initially size 1 contract here, buy 3 instead, actually at 6,004. Let's say you don't top ticket, you miss it by about 2 points, you get it by 4 points. But now you're getting 75% of a 4-point difference. So you've moved your short average by 3 points higher, right? So you can also use this in the reverse. And we do this quite a bit. So ratio tables aren't just used, position sizing isn't just used to save a position, but you can get really, really aggressive if you think there's going to be like a big punchy candle. Sometimes I don't know the sequence of the candles, right? I know that there's going to be an important level here. Let's say I want to go short. And then I think, maybe there's going to be a candle that punches above. So maybe I can actually move my short average actually beyond the level that I'm looking for because of some of these candles. So that's another way to get like a higher short in or a lower long in, something like that. Let's see. Who says, what if your edge is wrong and it completely drops? Yeah, so in that case, you either just got to go for a stop or you just got to lock out, right? So there's no 100% mitigation strategy, just tools in the toolbox. So what happens, if we just poo-poo happens, then poo-poo happens. Let's see, so Umada, is there a financial advantage other than just digging out of a hole? No, right? So, okay, that got answered. You speak of points, does points have a dollar level? What do you mean, Jay? So, yeah, Luigi, that's right. You can put it like that. Is there a math for adding as it's going in your direction, or is that a different... What do you mean, the math as it's adding? It would just be the same ratio table. Yeah. Yeah. So, like, for example, Coyote, when we're talking about this ratio table, you can use this in the reverse as well, right? So these figures don't have to be 1-to-1; they can also be 2-to-1. So instead of 66, you're getting 33%. You can also do this in, for example, you start off with 1 contract, you want to aggressively get up to 5 because you think in the chance that it breaks through and I can get up higher, I can get 83% of whatever that next candle is going to be by doing something like this, right? But here are some things to consider, right? If you start with 1 contract, then you go to say like 3, you add 3 contracts, and now you're at 4. Let's say you have an account that can only tolerate 15 contracts. 15 divided by 4 means roughly 3 point something, right? So you can technically only go another factor of 3. So let's say if you want to go from 4 contracts to 8, then you only have 7 left. At best, you can do slightly under 50% manipulation. So these are considerations to take in for if your market candles might punch lower or might pierce lower. when the higher and higher you go into contract size, you have to be very, very cognizant of how much room is left over with your contract sizing. So if you're already at 8 contracts and you have 7 left in your reserve, you can't even do a full 50-50. You can maybe do like a 47%, something like that, right? 45%, something like that. And so if that next move down doesn't work in your favor, and you can only manipulate by another 15, mind you, by another 50%, and mind you, you're at 15 contracts, you really have to start considering drawdown, and we're just stopping the position, right? So the next thing that we kind of get into is drawdown. Let's see, let's catch up on some questions. Shulk says, how are we timing the extra contracts? How do we decide now is a good time to average down? It's a very good question, Shulk. Very, very good question. The answer, I mean, that's a very long answer, so I'm going to say the TLDR. Some of this comes down to just instincts that you will develop as a trader over time. So I think for as much as we want to kind of quantify everything in the markets by numbers, oddly enough, like I have like some reservations that the market actually is closer to like a craft, an art, a skill, than it is to a simple kind of an analytical game that you're playing. Some of this does come down with instincts and intuitions that you will build over time. Right? So in our previous example, that original trader, he's been burned by buying on a candle breakout. A candle quote unquote confirmation is something that a lot of people online will talk about, right? So wait for your candle confirmation, then buy in is something that gets thrown around a lot as an advice. It's kind of garbage advice, I'm not going to lie. It's like trading 101 advice meant to make you blow your account, if I'm honest. Because more often than not, candle confirmation breaks are kind of whatever, right? You guys have heard me actually say the exact opposite on mainstream, right? That every level gets one break, then it can come back down. So we don't know if this is a real candle. We're always open to a fake out beyond the level, right? So it's the complete opposite advice that I talk about on mainstream. How did I learn that? Over time, because you get burned, right? So in this particular case, this trader waits for the pullback before he goes long. How does he know that? Well, instinct, experience, right? So you will develop that better. But once you do Shulk, right, and once you do, you guys will be able to understand more of the analytical side of the craft, which is manipulating raw numbers. So JC says, I've always heard about advice of not to average down, but to average up instead. I don't know why someone would say that. It's far, far, far too simplistic of a thing. You want to never take stuff off the table, I think, when it comes to position sizing. Don't be afraid to average up. Don't be afraid to average down. You will see, JC, in the mainstream, a lot of the times what happens is, we, say, for example, enter 3 contracts here. Say that this is our initial position. Okay, let's say this initial position was 1 contract and it wants to move up. So pretend, for example, because I don't have a chart here, pretend that the market's trending this way. Right? Let's just pretend for a second the market moves right to left. So let's say you do 1 contract down here, JC, and then you buy, you start moving into profit like plus 200%. You can essentially start to get free contracts, right? So you're using your profits to buffer your drawdown. That's something we can take this position sizing and run it in reverse to get ourselves into extremely aggressive contract sizing. Actually, you know what? No, we can do this with a short. So let's say instead of going long, you go short here at 1 contract. It starts to come down, right? And then you want to buy extra contracts. You move your average entry down by whatever your ratio is. But you can start moving your stop loss to your entry price. and then you essentially are getting yourself into a higher and higher leverage position for free. That's something that we do on mainstream quite a bit. Now, averaging down is one thing, but averaging up, you can also do that same example. So don't be afraid of averaging up, especially if you're going long. You definitely have to average up with that kind of position sizing. Okay, Gratonian says, Umada, is there a vid showing how you got those levels on the chart, standard deviation, unusual activity? Yeah, so that will just be covered more extensively in the mentorship. But to give you the TLDR of how we derive these, it's a number of ways you can do this. You can do this either with exposures, with dark pools, with call options, with you can do it with calculations. You can some of these levels are straight up just derived from the Greeks. There's a whole host of different things that we can do beyond just the simple things that we kind of talk about on mainstream. So mentees that have kind of been through the class know that on the main stage we'll talk about your standard exposure level, call level, right, or dark pool level. Big buying, big institutions here. Hey, it shows up on quant data. Put this on your chart. We talk about that on mainstream a lot. We don't talk about actually some of the more advanced stuff that mentees go through, which is, okay, how do we use second order derivations, third order derivations, and derive levels like this? So beyond even just your classic standard deviation, we can get much, much more in depth into this kind of stuff. So standard deviations are fine and all, but they're not the only tool in the toolbox that we have. So there's a lot more interesting things that we can do. So these levels that are derived, like, what was it, 6070 the other day, was not an exposure level, was not a dark pool level, it was not a call level, it wasn't a deviation, it wasn't a psychological level, it was purely derived with second order derivations. So today as well, I think we had 6120, I believe it was. My memory's a little bit fuzzy. The one that was called on stream for before we went to 6128 and we consolidated there. That wasn't a call level. That wasn't a dark pool. That's not a call exposure level. It's nothing. That's purely a derivation from using math. So Eddie says, you said you get one break before it falls. What if you bought your initial contract even higher at that second break and now it falls? You said you get one break before it falls. What if you bought your initial contract even higher at that second break and now it falls? Not really entirely sure what you mean by that. Trading books, Luigi says they have always stated there's a difference between averaging down versus doubling down. That was the point of my last question. That is how I understand why it's okay to average down instead of averaging up. Yeah, so doubling down is, I'm assuming double here means double, right? So you're going for very aggressive doubling of your position, right? Versus just kind of averaging in. You can buy like 10,000, then throw in another 500, throw in 3,000 here, throw in 7,000. Averaging over like a long duration for, say, investments, for example, you're really not considering too much of your ratio table. I mean, you should obviously still, but it's sort of just getting an average price. So you'll see this a lot with pensions, right? They'll do like a quarterly buy-in for averaging. They'll average, like Luigi, they'll do 10,000 in quarter one, and then 10,000 quarter two, three, and then four. And then you end up getting a 1-to-1-to-1-to-1 ratio, more or less, throughout the year of wherever the prices are. But doubling down, it's different because you're trying to exactly get 50% of whatever the movement has or hasn't done for you. Let's see, there's some more here. Eat up. Keep losing audio recorded. Are you guys having audio problems? No? Okay. So let's get into drawdown. Yeah. Speakers to sexy. Yeah. Nice. Thanks, guys. You guys enjoying this so far? 100%. Nice. This a side of OA that you guys didn't know existed? Yeah. Yeah, because I was thinking back, like, you guys have probably never seen one of my presentations, and you guys probably think that OA is just mainstream and funny jokes, right? Um, which is fine. I literally love NPO's jokes. I think he's got like one of those. I mean, if you like satire, if you're a fan of satire comedy, he's pretty good. Um, at least to my humor taste, right? But there is a side of OE that gets extremely serious and professional with this kind of math and the learning and stuff. And when we kind of really sit down and work through examples and work through topics like this, it's different, much, much more different than whatever it is we're just kind of answering on mainstream. So I hope you guys like it. We'll try to do more of these stuff. OA does the math too. Absolutely, we do. We get actually quite a bit into math. So right now we're running on, let me see, about 50 minutes of presentation time. Mentees will tell you that mentees, how long were you guys in lecture every single day for that first week? Tell them how many hours. 8 hours, 7 hours, yeah. So this times 8 hours times 10. I think the longest one we did was 10 hours, yeah. Yeah, brain dead, just absolutely thrown, just information dump. So these presentations go on very, very, very long. There's a lot more information. Yeah. So next one, let's look at the drawdown. So the original position that we have is one contract. Let's kind of look at what happens. So let's say we don't do any sort of averaging down. What does this position kind of do for us? What is the power of positioning? And the first entry here, we have one ES mini contract at 6,004. If you don't know what that is, if you don't trade futures, essentially that's like one SPX share, but on future side. So just instead of a share, we call it a contract. Simplified view, not exactly, don't hold my feet to fire on that. Price drops to 59.88.4. That's down here. So our initial entry of 6,004 drops down here. The move against us here is 15.5 points. What does that mean? 15.5 points times $50 a point here. For every point that comes down, we're losing $50. We get to $775. Right. So how do you translate these to the guidelines of options? Pika, that's a really good really good question that I'm actually going to answer right now, so I'm not going to save that for Q&A. Futures is a 1-to-1 directional, so there's no premium lost. If we lose 15.5 points, we can just times that by our point movement. That's $50, and it'll always be $775 loss, total drawdown. On your futures side, you have decaying premiums, meaning that if we move down 15.5 points, you might be down depending on what your expiry is, depending on when you bought it, depending on how much premium is being priced into the market at that time. Are we in a high or low volatility environment? Is one side stacked on the delta a lot more, right? For all of these considerations that go into pricing your options contract, it is not a linear drop that happens for you if you were to take this as a one contract, like a one call option. If you bought one call instead of a one long and you wanted to go and sustain this move down, we can talk about ratio tables still for your options, but you have to understand you don't have a linear decay. You have a curved decay, meaning by the time we get down here, you might already be down minus 70% on your contract for option side because of the premium decay, right? If not more, depending on what you're buying. So in those cases, unless you're absolutely you need to leverage much, much higher than if your drawdown is non-linear drawdown. So futures is linear. It's 1-to-1. 1 point is always going to be $50. 1 point is not always going to mean like say minus 5% on an options contract, right? So if that's the case, if it could be higher or lower, your ratio table becomes exponential function, right? Not a linear function, or in some cases logarithmic function, right? So that's a consideration you need to take. So this original position here, thank you for asking that question. So this position here sustains a drawdown top to bottom, $775, right? Most accounts can handle a $700 drawdown. But let's look at it. What happens when we start buying it? Modified position. This is the second position. Second entry here, we're looking at 3 contract sizing at so we buy the 3 contracts, we move the second entry down to 59.96, right? So we get 80, like 75% of the way down. The move is minus 7.5 points from 59.96 down to 59.88.4 works out to 7.5 points, right? At 4 contracts, this is going to be $1,500. Following the math here, $50 a contract times 4 is 200. 200 times 7.5 points gets us to $1,500 drawdown. So we've effectively turned a $775 drawdown on a move like this. Your Pika Pika says you had a $700 permanent drawdown today. Well, okay, not all accounts can sustain $775. Most accounts generally, not Pika Pika's, not today. So why would we do this? Why would we take $775 drawdown and turn it into $1,500 in drawdown? Questions. Let's open this up to the chat. Why would we possibly want to do this? To double our losses on a move like this at the bottom. So let's go in and play devil's advocate. If I had just held this position, I would only be down 775. Like an idiot, I bought in extra contracts because I saw someone on main stage buy extra contracts, and so now I'm holding $1,500. You start freaking out, right? This is where you start swerving in your eval and blow it up, or you're funded. Hopefully not you're funded. So why would we do this? Jay Hawker says double your upside. Good. Yeah, not too bad. So we're actually going to run the math on this, Jay. So the reason why we sustain the bigger drawdown is because, one, the manipulation, this average, it might not come back down to 6,004. I mean, it might not come back up to 6,004, right? So getting it down to 59.96, we might say to ourselves, even if we're at 59.88, maybe we can still see 96 as a potential. So at this point, we might not be too concerned about profits. We're more concerned about getting our money back, which is very important. So if you can't see the move to 6,004, you can see the move to 96, then the average down makes a lot of sense to you, because the trader who's holding the one contract here has lower drawdown. But he's going to be, by the time we get back to 6,000, he's going to be in that position, and this is something that every trader has been through, where he's like, oh man, I just need 4 more points. I'm almost back at my entry. I just need it. It's just, come on, just give me one candle pop. And it never happens. In this particular example, actually, the market actually never breaks 6,000. We actually fall after this. It's actually quite a big fall after 6,000. And then we kind of gap up overnight again to get to where we are today. But this 6,000 rejection happens again. We didn't really break that 6,000. So this trader would have, yes, had lower than 775 drawdown, but by the time he was back up here, he actually never makes it back into the green. Yeah, never makes it back into the green. So he looks at lower red, but he stays red. So, and then he becomes big red after. Actually, he doesn't sell. Whereas this trader is looking at big red, but he doesn't stay red. Right. So let's look at this. The modified position scaling in improved our average by about 8 points. Position sizing increased by 4. Right. We go from 1 to 4 contracts. Total realized drawdown increased by 2. If the position returns to the original price of 6,004, we realize an extra $1,600 in gains instead of breaking even. Right? So this is the modified position that we're talking about. You have a total of $1,500 in drawdown that's opened up, but you've moved your entry price down by 75% of the draw of the fall. And if we are able to come back up to 96, which is a much more likely move, you have a very good chance of getting break even. And if we actually do somewhat move all the way back up, you're looking at a total potential realized gain of $1,600 rather than breaking even. And that's how we can manipulate this kind of stuff. So I'll get into the downside coyote step by step coyote. Yeah. Here's the P&L comparison. Original position would be down $250 at, let's say it returns back to basically the high price here and then actually falls after. So we return to $59.98.82. The original position would still be down $250. The modified position would actually be plus $600 at $59.98. The difference here between being down $250 or being plus $600 is $850. So what does this $850 mean? Right. So what does this $850 mean? So the $850 on one contract here, $850 divided by, are we missing a slide here? Rekius? It's okay. We'll do the raw numbers here. So $850 divided by $50 a point means that the original position, the difference is 17 points to make up this $850, right? 17 points. Whereas when we're looking at a drawdown of 600 here, actually, no, I think we are kind of missing a slide, aren't we? Give me 1 second here, folks. Ah, okay, I see. It got moved to the bottom. Okay, I got it. It's here, Rekius. It's just out of order. Yeah. So here's the position sizing. Everyone give Rekius a thumbs down for doing this. Should he be fired? No, I'm just kidding, guys. No. Boo! Do you have a family? All right, he gets to live. All right, I've got a soft spot. So the P&L difference here, here's the comparison, right? The P&L difference is $850. The original position, $850 divided by $50 here, we get 17 points to break even on the original position. The modified position has $850 divided by $200, which is 4 contracts. Takes only 4.25 points to break even, right? So we have 4 times sooner to break even and start making money if we believe in the analysis of, us at least retesting 6,000, or at least us kind of coming back up to maybe 6,004, something like that, right? There's like a million different situations in which we can kind of apply this. There's no one glove fits all kind of sizing here for now. But this is kind of one case point where we can turn a situation from not that bad to actually pretty good. So, right, we get to essentially we've doubled our drawdown, but we've quadrupled our chance of breaking even. Right? You guys gonna see that? So why would a trader want to do this, right? Why would a trader want to go from minus 775 and sustain a $1,500 drawdown for this? Because he's actually doubling his drawdown potential, but assuming he can survive this on his drawdown in his account, assuming he can take $1,500 on his account, and assuming that he's even kind of factoring in for the amount of candles that could go against him down here, maybe he can sustain up to $2,000 for this, right? Maybe this is a very, very important level. Maybe down here we're playing for 6,000, we're playing for a big exposure, we're playing for a number of host of levels, right? Whatever makes you want to take the conviction in that trade to begin with. He's calculating, all right, if I leverage up my contract sizing to 2,000, maybe I can get to, say, this or this, and I can sustain that drawdown. But I'm quadrupling my chances of coming back up. So stop orders. So Coyote, before we get into stop orders, any questions on drawdowns, ratios? Can I build your drawdown for you, Hogdukin? Extra double cheese asks a good question. When would you consider sizing more than 3 in that situation? Very good question. My short answer is it's going to have to be a damn good level. It's got to be the kind of, it's going to have to be something that you believe in, and not just because, hey, there's a level, let me try something here, which is what a lot of traders do, right? Hey, I've got a bunch of these levels on my charts. Let's try this one here. Let's try another pivot here. That's not how you're supposed to trade. But yeah, when said always start with one contract, short answer is obviously no. Right? There's different. If you ever look like at a curve of anything, there's going to be a sweet optimal point on the curve where, like, it peaks on the curve. You can call that your strike interval, your highest conviction interval, and placing the highest number of contract sizings there is going to be your best your best chance. USD approved, yeah. BD Bull says, so do we ignore the possibility of it going down even further because we believe in RTA that it will return to 6,000? Yeah, so BD Bull, could it break much lower? Yes. Right? Do you get burned on positions trying to do position sizing where you would have been better off just cutting? Yes, absolutely. Right? This is not a miracle, cure-all, panacea kind of strategy. It's meant to kind of give you guys more tools to consider when you're trying to trade beyond just buying and selling, beyond just entering and exiting a position. There's a lot more things we can do. So say, for example, you're the kind of trader, right? So here's an example of when I actually do positioning sizing quite a bit. Say that I'm a particular trader who's trying to play for a 6,000 short. I really like this idea of a 6,000 short. I really want to do it. But I know that there's counterparty and they're going to want to ramp it up. Take your level of choice here and put it in, right? In one situation, there's a number of different ways we can approach this. Like strategy one is we go, wow, 6,000, I'm going to go buy short. It breaks past, and then you just sell it. You take the loss there because you get your quote unquote confirmation candle that all the people on YouTube who don't know how to trade tell you to look for. And then it comes back down and you go, damn, I shouldn't have sold it. Situation two. All right, 6,000's here. I want to go short, but I'm not going to let it free ride. I'm going to do a stop loss right on the other side of 6,000. surprise, you get tagged. You take the loss, then it comes back down. Okay, try again. Situation 3, which is what I kind of like to do, and this is something that I do a lot, where I will enter one initial contract because I understand that the move rejecting off of 6,000 is going to be big enough for me to make the kind of money that I want to make off of it. It's not going to be like a 1 point rejection on 6,000, right? It's going to be a big one. So what I'll do though is I'll say counterparty might want to break past this level. I'm very cognizant of the stop loss rates that happen, right? So situation 3, I enter with the smaller initial con sizing, and then I'll add more as it goes up there. And then that ways I'm not getting stopped out all the time, trying to play the level over and over and over and over again. If this feels like something that happens to you guys because you don't know what else to do, you don't know how else to approach a trade, we don't always have to just go, I'm going to go short at 6,000 and then place a stop loss above and then keep getting repeatedly smacked out. Another way that we can do position sizing with these ratio tables is we go at 6,000. I'm going to initially enter like one contract. I'm going to, leave myself kind of open to the tolerance here, right? So do your quick math, right? If you think it's going to break by maybe 5 or 6 points, something like that, you can do somewhere around 250 to 300 in drawdown. But it doesn't have to be a permanent stop loss. It doesn't have to be a physical thing that's going to actually kick you out if it hits 300. It just means that mentally you're calculating your own drawdown, right? It's going to be minus 250, minus 300, and then because we understand ratio tables, 6 points against us, we can flatten that 6 point difference very, very quickly. Right? Simply adding another 3 contracts and kind of getting to 4 contracts can actually flatten most of this 6 points that have just gone against us. And then we can move our average entry up to pretty much like 6,005 point something, 75%. So what happens when it comes back down to your entry price? You can sell those extra contracts and go back to your comfortable sizing. You don't have to hold the 4 through the move. As soon as it gets back to break even here, right? You've moved your average entry so aggressively high that when it comes back down, it starts putting you in profit. You can cut those extra contracts that you've got, or you can hold them, whatever you want, right? So that's one way that we can use the position sizing to not get repeatedly smacked out, right? So you think to yourself, this guy's just talking about DCA. No, we're not. We're really not. If you kind of take away from this presentation that it's all just about DCA, he's just talking about very basic averaging down, good luck, right? There's something a lot more complicated going on here because there's multiple ways to approach the same trade. So understanding positioning sizing is going to allow you to manipulate average entries the way that you want it to, even when you get them wrong, right? So let's see. There you go. Thank you, all Betsy. Betsy, you're the GOAT. Loss ended up being $48 gain sizing after timing right. There you go. Do you trade position sizing differently with evals compared to when funded? Yes. Yes. Zeus the goose. With evals, speed run those. There's really no point. Assuming you can afford it. Assuming you can afford it, it's just a numbers game on evals. Right? Need a better term. When you're saying that we do this when we have the confidence in our thesis, though, correct? You're saying that we do this when we have... Correct? It's not just willy-nilly. Yeah. Very, very key point here, Coyote. Like, you're doing position sizing on levels that are very, very important. Like, this isn't... I'm not just doing position sizing on 59.93.35 just because it's a level, right? We're doing position sizing on this particular example because it's 6,000, right? So... Coyote, you being through the mentorship, you're going to know a whole host of those high confidence interval levels, all right? So these are the ones that you're going to start employing position sizing on, not just some random level that's somewhere. So egg roll, so with the mental stops that we have in place, right? So instead of running, your classic standard stop loss, we want to approach this with like a position sizing, maybe manipulate our average entries. So what happens when we get a huge news candle that takes us out? That's just the cost of, running a strategy like this if you want to do mental stops. You can still have, don't get me wrong, you can still have your ultimate stop loss in place. So you can still, for example, if you want to play for like 300-400 drawdown like what we're doing here, or $500-600 drawdown like we're doing here, you can still place, maybe like if you're on a self-funded account, or you have a drawdown bigger than 4,500, you can still place a stop loss up here for like an ultimate fail-proof thing that you don't think it's going to immediately kind of come in. Let's say we think this is going to bounce around 10 points, right? On one contract, you're talking about $500. But if we don't think this is going to go to like minus $1,500 on one contract, we're pretty much safe that this stop loss is there just to kind of capture a crazy 100-point candle news because Trump just said something. You can still employ both egg roll, right? So you can still give yourself the fail safe of not having a crazy black swan event kill your account as you're trying to do this. But you can still employ position sizing. So that's something you can do. Absolutely. How does it work with intraday drawdown? Does this help mitigate this too? Intraday drawdowns are really kind of not going to work too well with this. Intraday drawdowns as a different strategy that you need to employ to beat that. Position sizing on this might actually fuck up your intraday drawdown. So if you have one of those intraday trailing drawdown futures accounts, position sizing could actually really fuck up your trailing drawdowns. You need a completely different strategy to approach those. And TLDR right now, if you're going to ask, is you basically just think the move is going to, let's say we're shorting for a $500 profit target. You're going to take half of that. So you're going to take probably whatever you think you can absolutely get out of that move. Maybe it doesn't quite go the full minus, plus 1,000 in your favor, but you think absolutely it's going to do halfway. You just set that TP for halfway. You don't maximize your profits with intraday trailings. You don't do that. The reason why is because you want to be taken out mid-move in an intraday trailing account, so that when you're wicked out, when you're stopped out at your position, you're stopped out at a balance high. In order to get stopped out at your balance high, you need to make sure that you're not trying to maximize your profit. You actually need to consistently undersell yourself to beat the intraday trailing drawdown. It's not something that a lot of traders think about. Most traders are thinking about, how do I maximize my profits? And that's why the intraday trailing drawdown kills their accounts. That's why prop firms know that this kills their accounts, right? After first payout processing went through, Rise Works approval has been submitted. Hey, good job, Lucifer. Little step, bro. Who changed his name to that? The heck? But yeah, no, Little Step, bro. Congratulations to you. First payout on Rise. There you go. Should be coming in soon. Can't confirm. I had to step away for like 30 minutes. Is there going to be a way to rewatch this? Absolutely not. I'm so sorry. This is going to get lost to time. I'm just kidding, Theta. Yes, it will be recorded. So we'll have this on our Twitch. We'll have it on our OA YouTube channel. I'll also have it on my own YouTube channel to add to the lessons that we've done. But yes, so let's go into the modified position, the stop orders. So what are the different kind of stop orders? This one's a little bit more simple, right? We don't need to get too creative with the stop orders. There's only kind of one big one to consider, is the difference between a limit and a market order. So do you guys know this, or do you guys need to hear it? So Luigi, my YouTube, Swayze, can you find it? There you go. Oh, perfect. Thanks, Humble Feet. Yeah, at Umada Trading. I should update that description. It's not 13, it's 14. Yeah. So we'll be uploading this there. There's also some lessons that I've already done on there, so you can go ahead and look at those. I like to hear in the context of futures trading in X platform. What do you mean, Coyote? What the various stops? Yeah. So stop limits here, right? So there's really kind of three different types of stops, broadly speaking. So you have your stop limit. This executes the stop at the desired limit price or better, but your risk is not being filled. So let's say you have a stop at $10, it absolutely jumps to $15, but you have a stop limit order here set for $10. It's not going to fill you. So goodbye. Your account's going to run. It skipped over your stop. I really don't like stop limits. Stop market's different. Stop market says like it executes at the stop price at the market rate. So let's say you've got a stop at $10, market skips past, it jumps to 15 on the next bid, which is crazy. We've seen 300-point candles, right? Especially when Trump is talking some of these tariffs, 300-point candles. That's going to blow through your stop limit. It's not going to fill it. But your stop market, it will fill it. It'll get you out, assuming you can survive a move like that. It'll get you out. But it's at whatever the new bid and ask spread is in the market. But as soon as we cross $10, it's getting you out on the next best price. The trailing stop. So I really like market orders, right? I think for all that traders try to do about market orders and how much this or that is, I think you end up actually kind of losing a lot more money into these limit orders than not. Okay, so trailing stop. This one I think is fairly self-explanatory. Just trails by an X dollar or percentage amount, right? Okay, so that is the presentation. So here we go. That is position sizing. Welcome to Umada's big beautiful workshop. I hope that you guys like it. And this was basically just a small excerpt here from Risk Module. So, if you guys like this, let me know. If you really didn't like it, let me know as well. For those who are still here, if you've made it all the way till the end, I do have a special announcement. So let me just answer some questions first, and then we'll get into the special announcement. Whoa, a lot of questions. So when you're on Top Step X, say you just wait till it hits your mental PT and then hit sell. So you just wait until it hits your and then you hit sell. No. I like profit targets. Yeah. I do like to just sell if I think if my tummy tells me to sell, Coyote. Sometimes I just do that. Yeah. You're welcome, Barnaby Beach. Yeah. So Luigi says when to do trailing stops versus setting a sell point. Often find myself breaking even more often than not. Why should when I use trailing stop profit instead of sitting cash? Trailing loss is not really something that I do too often. Future cycle levels. Psychological levels, yeah, okay. How do I identify those? That would be another. Well, okay. TLDR here, Luigi. Psychological levels. If you want the quick and dirty version, whole numbers: 5,900, 6,000, 6,100, 6,200, etc., etc. How about reading the tape? I rarely see anyone in OA channels reviewing the tape in conjunction with the data. Why is that? Is it the old way and not just recommended? If it's recommended, where can I see the tape trading view? What do you mean by the tape? Because we're always reading the tape. The tape is just the price. I think we do read the tape. Is there a specific way that you like the tape read? Just got here. Thank you guys. Special announcement. Rekius is fired. No, that's not it. No, it's not. Let me see. Let's get through here. Thank you guys. I'm really glad that you guys like it. Yeah, if you liked it, let me know. You must see old ticker tape. Tag. Okay, so there's a lot of comments. Okay, so special announcement. For those who I know, some of you have been wanting to enter the mentorship, but you've been kind of wondering, are we going to do promos or discounts off for the mentorship? So I know some of you have been waiting. I know some of you are waiting and said, listen, I'm going to kind of come to the workshop and see what this is about. And then I was thinking about doing a promo code, because last time when we did mentorship, we had like, promo codes for X dollar amount off. So we will be doing doing that again this time as well. So we're going to give away 3 $500 promo codes. Now, if you are someone who is interested in the mentorship, this is not a solicitation. It's only for those who want it. If you want to do the mentorship and kind of see more of what we're doing and the entire full gamut, not just risk, not just position sizing, not just, etc., but we're talking about the market and about strategies, and we're talking about mental and science and all that kind of stuff. We're giving away 3 of the $500 discounts. Yeah. So some guy, if you can't afford it, that's fine. Like, again, that's what this free workshop is for, right? And if you are someone who has signed up for it already, then we will honor it. So let's say you've already paid and, you end up being the winner of this, we will credit you the difference. So, last day to sign up is July the 6th at midnight. So we start July the 7th. How much is it? It is 7,000. Are we going to do more workshops over time for the rest of the info? No, we will be respectful of those who've paid for the mentorship. So we won't just make them pay and then give out all the information for free. To be honest, I don't really even think it's going to be so much information. Like, it's crazy. So why don't we do this? Do you guys want a super coupon? Super coupon. Super coupon is no super coupon. Yeah, so the way that we're going to do this is for those who want it, only if you want it, mentorship is $69.95. This is for $500 off. So it'll be $64.95. Okay. Only click the button if you want to enter mentorship. You don't have to pay right away. You can sit on it. But if you don't use it, then it expires. That's fine. I think that's fair. So last day to sign up is July the 6th, midnight Pacific Standard Time. So Rekius, or do you want to set up a box Rekius for 3 winners and then click it if you want?
How much time did you want to give?
We can just kind of do, like, honestly, an hour here if you want, just for the people who are here right now.
Sounds good. 1 moment.
Yeah. So you can enter to win. Click the box, right? Rekius will do the box here, and we'll just pick 3 winners from that. And is there going to be another